What's going on, guys? Thank you for tuning into this episode of Twin Finance. My name is Dylan, and today I'm going to answer the question, or at least try to help you guys understand, if the interest rates rise, what that means for the stock market. And before we start talking about the stock market, we just need to, if we just think logically about interest rates, guys, what does that mean? So there's this thing called the Fed. If you guys don't know about that, Federal Reserve, commonly known as the Fed. And each year they set the interest rate, right? So they have the ability to change interest rates and whatnot, and they regulate the money in that's in the United States. Obviously, every country has their own, Federal Reserve and whatnot. So if the interest rates if they rise, so what that means is usually that's the Treasury yield for the year. So let's say an interest rate rose from 2% on the Treasury to 3%. So it's at 3%. Well, what does that mean? Well, that means that the interest rates are higher on money lent out. So banks are going to raise their interest rates. So banks raise interest rates. Banks raise interest rates, and on things like mortgages and anything like personal loans and whatnot. So their interest rates are higher. And that also then, if banks are raising their interest rates, personal lenders and whatnot, it's all really relative, guys. So money basically just becomes harder to acquire. So it's not that, people are making less money or the economy's going to shits and whatnot. It's just money's harder to acquire. So if money's harder to acquire, let's say a person, they're on a $80,000 salary, but interest rates rose on their home, and now their mortgage payment is a good, let's say a few $100 more per month because they got a higher interest rate when they refinanced. Say that year the interest rates were up. Well, their salary didn't rise any because maybe let's say they're locked in for $80,000 for 6 more years. There's less money in that household now, right, guys? Because it's just harder to get money, and banks are assessing stronger, and money's not as easy to acquire. So basically, you guys are probably wondering, what does that have to do with the stock market? So I'm just going to write down here is basically when money's harder to acquire, guys, it's less, there's less new money. So when there's less new money, so that would be money that, banks are lending out and whatnot. So less new money, and that means that less money is going to be put into the stock market. So if we just think about the stock market, obviously, what makes up a lot of the stock market is the bigger funds and whatnot is, investing in these vehicles. It's not going to be your average everyday investor times a billion that's making up the market. It's going to be the big investors, Warren Buffett, whatnot. The massive companies, they're making up a lot of the stock market. So if there's less money flowing into companies, because of interest rates rising, that really it slows down the money going into the stock market. It doesn't mean that the stock market's going to crash. It just means there's a lot less new money being flooded into the market. So I don't know if you guys ever heard about margin investing. So investing on margin, that basically just means it's not your money you're investing in. So let's say you took $30,000 from the bank or your financial institution, and they set your rate on that, 4%, 5%, that's what you're going to have to pay us on the margin, on the loan we give you. Well, all that investor does is say, hey, I got to be 4 or 5% on the year, or however long it is, and that's how I'm going to make my money on investing. So when it's harder to invest on margin, it's the money, there's less new money, right? Because obviously that $30,000 is new money to that person. So the stock market, I'll just write SM. So less new money means less new money. So if there's less new money flowing in, it doesn't mean that the market's going to crash. It just means the money isn't being flown in as enough, and that just means people are going to be managing their money and allocating it in different areas and whatnot, maybe even selling out, to make their money liquid, so they have to use it for bills and whatnot, whatever that may be. So we could possibly say more selling. And another reason for more selling, guys, in the stock market is if the stock market starts to slow down a little bit and, returns are kind of flat, well, that bond at 3%, the Treasury bond and whatnot, or even businesses will raise their bond rates it's going to be more attractive to the investor. So if they say, hey, look, I could take some risk and get 10% return in the stock market, or I could just accept 4%, 3%. That's a rock solid return for some people. You know what I mean? Like, not everyone's looking for the home run. It obviously makes bonds more attractive, and when bonds become more attractive, more selling, right, guys? More selling is because they're accepting, hey, that bond, that's a pretty decent return on my investment, beating inflation. It makes bonds more attractive, so we can just rate more attractive bonds, more attractive, and I'll just write bonds next to it. But like I said, guys, it doesn't necessarily mean the stock market's going to crash. It's going to be interesting to see how it plays out right now, because interest rates probably are on the rise, and they are going to probably continue to rise for the next couple of years. So it's going to be really interesting to see how that plays out. It doesn't mean that there isn't money to be made in the market, or that we're going to go in an economic downturn. It just means it's going to be a little harder to make money in the stock market. It's not going to be a 2017 year where just pick your stock and it's going up that year, guys. The market was up 30%. It's not going to be those types of years, guys. In the coming future, interest rates are on the rise. Like I said, less new money in the market. It's not that there's not money to be made. That's the two things I want you guys to take away from this video. It just means there's less new money flowing into the market, and it's not impossible to make money when interest rates rise in the stock market, guys, even if the market's flat. So I hope you guys enjoyed this video. Feel free to leave your comment in the section below. Also subscribe to the channel, and have a great day.